Well, greetings and salutations, Series 7 test-taking weekend warriors. This is the Series 7 Guru coming to you on a fun day Sunday from my studio here in fabulous Las Vegas with the last weekend explication request. The best free supplement to your paid study materials is my YouTube channel, but if you don't already have a Kaplan QBank, I highly recommend it as a paid supplement. We help with all questions, but if it's Kaplan, it's easier because you can just give me a QID and, I can pull it up backstage and we can look at it. If you don't have a Kaplan QBank, with my Guru 10 discount code at checkout, Guru 10, you can get it for about $60. And for that commercial, I'd also recommend the quick sheets. That's about $18. Those are really good as well. Before that commercial, Kaplan allows me to give you free look on Kaplan content. So let's get busy on this one. QID 1264902. So if you're using Kaplan and you want me to do a question, you just give me the QID. If it's not Kaplan, then you're going to have to do the old-fashioned way, cut and paste. An investor is holding a broad-based, diversified portfolio of stocks and feels that the market, so our first keyword here is the market. So market is important. So we're not worried about nothing in here about a particular security, nothing in here about a selection in my portfolio. So that's kind of key. So, which has slowed recently and be poised for a brief fall before it continues upward long term. So it sounds like he's worried about a fall in the market. And that means what he is worried about is systematic risk. Market risk, right? The tendency of securities prices to move together. And it says that what they're afraid of is a brief fall in the market, meaning they think the market's going to go down. And it continues upward long term. So they think once it takes this little dip, it's going to continue up. So that means I want to be able to participate in that long-term movement upward. The investor does not want to incur the cost of selling a portion of their holdings. So it says, I don't want to be selling my any of my stocks. So let's just get out our little matrix here. If you use a matrix, that's what I recommend. But even if you don't, you can kind of say, okay, well, it just says they don't want to have to sell the stock. So, if we go over here, I'm going to have an obligation to sell, and the stock could get called away from me. And they just told me that I don't want to do that. In other words, it's not going to be a short call here. So let's just get this. Whoop. So that would be an obligation to sell. Now, I don't see anything in here about the stock. So I think we're going to be using an index option here, right? You should definitely know index options are T+1 settlement, exercises T+1. It's in cash. Or assume the risk of mistiming the market, meaning getting out of the market entirely. A possible strategy would be, so I think what I'd want to do is something that I can make some money. If my portfolio goes down, I could make it up by something that goes up. I think I'm going to be looking for something that has negative correlation. So what goes up if the index goes down? Well, what goes up is the intrinsic value of an index put. So I would be hoping that whatever I lose in my portfolio could be made up by an index put I'm holding. So I'm going to be looking for here, buying some protection, buying some term insurance. Now, it's important in this question that we're able to determine that this question is not about a particular selection. If I was worried about a particular selection in my portfolio, I'd buy a put on that particular selection. What I'm worried about here is insurance, not on a particular stock, but insurance on my portfolio, right? So that's kind of an important distinction. I will link to my 20, I think, very reflective practice questions on non-equity options for you to try. You should definitely know Epic, for example. So I'm going to be looking for buying an index put. My idea here is that what I lose on my portfolio would be made up on the intrinsic value of the put contract I'm holding. And I could exercise that put, remember, settles in cash, and that cash would offset what potential losses. So let's see what our choices are here. Choice, buying an index put. You should definitely know we're not going to sell an index put because that would be an obligation to buy. We don't want to buy. We're interested in selling. So you should have been able to get this to a 50-50 by knowing we need something that's bearish, right? Because what we're afraid is the bearish move, the opposite market move, which is down. So we should have been able to eliminate that one. Buying index call, that wouldn't hedge it because, call would be, again, bullish. I need something that's bearish. The call option isn't correct because remember, I sell that index call. I'm not going to be offsetting or having negative correlation as the market goes down. I get some, protection, I guess you could say partial protection, but that's not really the best answer. So I don't know where the test taker missed this particular question, but I think the particular way to miss this question would have been perhaps with the index call to think, well, I get a partial hedge, I guess. But given that answer set, the best answer is to buy an index put. This is very much a testable scenario, right? So if what I'm worried about is the entire market going down, I'm not worried about a particular selection. It'd be more efficient to buy the index put than buy puts on every stock out. In fact, doing that would be a possible churning thing. Okay, let's see what the explanation is. By not liquidating, the client can benefit of the market increases. Because I think that's an important point, right? It's not about what if I'm right. Hedging is about what if I'm wrong. If I'm right, the market continues to go up, and I will have wasted my money for the protection or the insurance. Because the portfolio is broad-based and diversified, it should move with the market. Again, that's called systematic risk and reward. I'm worried about the risk, not the reward. An index option also moves with the market and therefore would be a good hedge vehicle. Okay. Hedge means offset risk. A long put should be used because it will increase in value if the market should decline. So, while my portfolio is going down, the intrinsic value of my put is going up. Okay, so that gets me caught up on explication requests. Remember, inch by inch, your Series 7 is a cinch. Yard by yard, your Series 7 is hard. I hope you got a lot of good studying done over the weekend. And I'll see you next week sometime.